Fred Bergsten is the director of the Peterson Institute for International Economics. He was also a top Treasury Department official in the Carter and Reagan administrations. He's with us live from Washington. Good morning to you, Fred. We got these new figures this morning out of China showing that they had a nearly $17 billion trade surplus. They've got foreign exchange reserves, biggest in the world, $2.6 trillion. Obviously, that's going to feed the argument about needing to level the imbalance here. Why are you arguing, not just the label, but specifically that the United States needs to go out and buy renminbi? How do we do that, and to what degree to level the playing field?
The United States has been trying for a number of years to get China to stop manipulating its currency. China intervenes to the tune of about $1 billion every day on average over the last 5 years. It buys dollars to keep the dollar strong. It sells its own currency to keep the renminbi weak. The result is an undervaluation of at least 20% of the Chinese currency. That's like putting a 20% subsidy on all exports, like putting an additional tariff of 20% or more on all imports, and that creates a huge increase in China's competitiveness, its trade surplus, our trade deficit. The direct way to counter that would be in the currency markets. When the Chinese buy dollars for their currency, we should sell dollars against their currency. Now, there's a technical problem. Their currency is not convertible. You can't just go out and buy it in the market like you can euros or yen. So you'd have to find proxies. But there are forward contracts. There are renminbi-denominated bonds and equities. We could do that. The message would be clear. I think that would be a very effective response.
Well, that's one way through sort of the market angle. But on the political one, you say the U.S. should label China a currency manipulator. Certainly in Congress, we're seeing efforts to slap tariffs on Chinese goods. But I mean, you hear from the largest private employers in this country, from Walmart, saying don't do that. There is going to be a cost. Isn't the risk of a trade war here ultimately going to cost U.S. jobs? Isn't that a real worry?
I think there's a risk of a trade war if we do not respond to China. China, as I say, is carrying out a massive program of export subsidies and import protection. China's currency policy is the most protectionist measure the world has known since the Second World War. It's a huge distortion. If it continues, then what happens is countries all over the world are copying it. That's the risk of currency wars. China keeps its currency down. Everybody else has to keep their currency down.
If the currency goes up, though, won't the U.S. stores and retailers just go to lower-priced competitors like Vietnam? Isn't this fundamentally about U.S. appetite here?
No, there will be some of that, but the price of the imports will go up, so we'll buy less. Some of the production will return to the United States. We do compete directly with China on some products, but the big gain for the U.S. is on the export side. If they stop putting this huge tariff on their imports, we will gain a big jump in our exports. That'll create most of that 500,000 jobs I talked about. The reason the U.S. has to label China manipulator is to rally other countries. We need an international coalition. If we're not willing to indict them, no one else will.
All right, Fred, we have to leave it there.